QUBT stock I shared with you went from $3 to $14. That's 366% gains, making subscribers serious money. But today's pick could deliver even bigger returns. I found a software company at just 58 cents that's been around since 1982, serves Verizon and major carriers, and just launched AI-powered family safety products. This stock traded at $760. It's now 58 cents. Stick around. Hey everyone, Sterling from Velocity Stocks, welcome back. I hope you're enjoying my best stock picks and finding real opportunities. Hit subscribe and turn on notifications. I post undervalued stock analysis weekly, and you don't want to miss the next opportunity. Let's dive into this one. The family safety and digital wellness software market is exploding right now. Parents are desperate for solutions to monitor and protect their kids online. With social media dangers, cyberbullying, and screen addiction at all-time highs, carriers and device makers need software that keeps families safe. The global parental control software market is projected to reach $6 billion by 2030. Growing at 18% annually. Wireless carriers are bundling safety features into premium plans to increase average revenue per user. Every major carrier, Verizon, T-Mobile, AT&T, is adding family safety services. The company I'm sharing today, Smith Micro Software, has been providing mobile software solutions to carriers for over 40 years. They're not a startup. They're an established player with existing carrier relationships, and they just launched AI-enhanced products that could position them for a massive comeback. This is about an undervalued software company at depressed levels with real products, real customers, and catalysts that could drive explosive gains. The company is Smith Micro Software, ticker SMSI, trading on NASDAQ at 58 cents. Smith Micro was founded in 1982 and is headquartered in Pittsburgh, Pennsylvania. They employ 164 people and develop software solutions to simplify and enhance the mobile experience for wireless service providers. Their flagship product is SafePath, a family safety platform that provides parental controls, location tracking, content filtering, and digital wellness tools. They serve major carriers including Verizon, and their software is embedded in millions of devices worldwide. This isn't some obscure penny stock. This is a 4-decade-old software company with established carrier relationships, trading at bankruptcy levels, despite launching new AI-powered products. Let me give you 5 reasons why SMSI at 58 cents could explode. Catalyst number 1. SafePath 8 with AI features. Smith Micro just launched SafePath 8, their next-generation family safety platform with AI-driven features. This includes enhanced content filtering, intelligent screen time management, and predictive behavior analytics. They're also offering SafePath OS for kids' phones, a full operating system designed for child-safe devices. Carriers are showing strong interest. This could drive significant revenue growth in 2026. Catalyst number 2. No inventory deployment system. Smith Micro announced major enhancements allowing carriers to configure standard Samsung devices with SafePath OS after purchase, eliminating inventory complexities. This makes it easier for carriers to offer kids' phones without managing separate SKUs. It's a game changer for scalability and adoption. Catalyst number 3. Strategic cost reductions. In October 2025, Smith Micro announced organizational changes impacting 30% of workforce, saving $1.8 million quarterly. That's $7.2 million in annualized savings for 2026. The company is becoming leaner and more efficient, which improves path to profitability. Catalyst number 4. Verizon partnership. Smith Micro has a master software license and distribution agreement with Verizon, one of the largest wireless carriers in the United States. Amendments to this agreement in recent years show ongoing collaboration. If Verizon expands SafePath adoption across its customer base, that's massive recurring revenue potential. Catalyst number 5. Extreme valuation dislocation. Here's the big one. Smith Micro's all-time high was $760 in March 2000 during the dot-com boom. It's now 58 cents. That's a 99.92% decline. Even looking at more recent history, the stock was $62 in the 5-year range. It's now 58 cents. The 1-year high was $1.90. It's fallen 69% in 12 months. The market cap is only $15 million. For a company with 164 employees, established carrier relationships, and a product portfolio serving millions of users, this seems absurdly undervalued. Let's break down the numbers. Current stock price, 58 cents. Market capitalization, $15 million. For context, that's smaller than most failed startups. Smith Micro has 40 years of operating history, carrier contracts, and intellectual property. At $15 million, you're buying the company for less than $100,000 per employee. Average daily volume, 140,000 shares. That's relatively low liquidity. This stock is thinly traded, which means volatility can be extreme. But it also means that when buying pressure comes in, the stock can move violently higher. All-time high, $760 in March 2000. If this stock recovered even 1% of that decline, you're looking at $7 to $8. That's a 12x from current levels. Let's look at recent price action. 1 month range, 58 cents to 63 cents. The stock is at the low end of its 1 month range, suggesting potential for a bounce. 6 month range, 58 cents to $1.13. Just 6 months ago, this stock was trading at $1.13, nearly double the current price. 1 year range, 58 cents to $1.90. The stock hit $1.90 in early 2025. That's over 3 times the current price. 5 year range, 58 cents to $62. At $62, this was a $1 billion plus company. Now, it's $15 million. The chart shows a multi-decade downtrend. But downtrends don't last forever. If Smith Micro's new AI products gain traction and carrier adoption accelerates, this stock could reverse violently. From a technical perspective, the stock is oversold, near multi-year lows, and showing potential for a sentiment shift. Now let's talk about the severe risks, because they're very real. Smith Micro is a penny stock at 58 cents. You could lose your entire investment. That's not hypothetical, that's real. The company reported revenue of $20.56 million in 2024, down 50% from $40 million in 2023. Revenue is declining, not growing. The company posted a net loss of $48.7 million in 2024, nearly double the prior year's loss. Smith Micro is burning cash. They completed multiple capital raises in 2024 and 2025 to stay afloat. There's significant dilution risk. If they can't reverse revenue declines, they could face bankruptcy or delisting. The stock has low liquidity with only 140,000 average daily volume. That means large spreads, slippage, and difficulty exiting positions. The family safety market is competitive. Apple, Google, and other tech giants offer built-in parental controls. Carriers might decide to build their own solutions instead of licensing from Smith Micro. This is not a conservative investment. This is speculative. This is high risk. Never invest more than 1 to 3% of your portfolio in any penny stock. Do extensive research. Read SEC filings. Understand the financials. Don't invest based solely on this video. If you can't afford to lose the money, do not invest in this stock. Alright, let's recap. Smith Micro Software, ticker SMSI, 58 cents, 15 million market cap, founded in 1982, 164 employees, Pittsburgh, Pennsylvania, NASDAQ listed, 5 catalysts, SafePath 8 with AI features, no inventory deployment system, $7.2 million in cost savings, Verizon partnership, extreme valuation dislocation. The stock traded at $760 all-time high, 5-year high $62, 1-year high $190, now 58 cents. Price targets? Conservative, $1 to $2 within 12 months if they stabilize revenue and show product adoption. That's a 70 to 240% return. Aggressive, $3 to $5 if SafePath 8 becomes a major success and carriers widely adopt. That's a 400 to 760% return. Downside risk. The stock could go lower. It could hit 40 cents or 30 cents if the company continues struggling. Bankruptcy is possible if cash runs out. My take. At 58 cents with a 15 million market cap, You're essentially betting on whether Smith Micro can execute on their AI product launch and stabilize their business. The risk-reward is there for a small speculative position, but this is extremely high risk. Here's what you need to do. Subscribe to Velocity Stocks for more undervalued stock analysis. Hit that notification bell. Drop a comment. What do you think about SMSI? Is this a turnaround play or a value trap? Let me know. Smash that like button if you found this valuable. Check the description for my research tools and Discord community. Final disclaimer. This is not financial advice. I'm not a financial advisor. Do your own research. Invest with discipline. Never risk money you can't afford to lose. Smith Micro is speculative, volatile, and high risk. Next time, I'm covering a stock that just broke out above resistance and could run to new highs. I'm Sterling from Velocity Stocks. Let's catch these stocks in motion. Peace.